Hello guys, welcome to the video of Inventory Part 2. So in this series of CMA US Part 1 Section A, this is gonna be another video. We have already covered inventory tracking like the LIFO, FIFO, average method in the previous video. In today's video, we are gonna see a lot more about inventory valuation. Let's start. So, what is happening? Why do we have this particular chapter? Why this inventory valuation comes into the picture? Because what happens, like suppose you are the finance manager of a manufacturing company, year-end report shows strong profits, but during audit discrepancies arise. Inventory counts don't match the records, some goods are obsolete, and valuation assumptions seems inconsistent. So that means what is happening that there is a strong profits are really good, but when the books of accounts are being audited, as we all know, our financial statements are always audited, like for the public companies, but for the private companies it's their own choice whether they want to get it audited or not. Now coming back to our topic, so what happened during the audit, when the auditors came and they reconciled the inventory, they found that what is actually mentioned on my balance sheet is not actually matching with what is there in my warehouse. Then some items they have been mentioned on my inventory, on my books of accounts, on my balance sheet, but actually in reality those are not in saleable conditions, or they have become obsolete, they have become outdated. And then so what is happening, because of this our profit will be revised, and even the stakeholders or maybe the shareholders, they will be concerned and they will doubt our financial statements. How and why? Because I am listing that okay, 1000 units of X and X, say XY goods are there in my warehouse, but in reality there are only 700 units. So what, my inventory is overstated, my balance sheet is overstated, right? My assets are overstated, to be precise. Then obsolete goods, outdated goods are there in my warehouse, but I am saying that those goods are fine, but in reality they are not in sellable condition. So I should do what? I should write down those particular goods. Where should the write down be recorded? In my income statement, and that will reduce my profits. If I am not recording that, what is happening? My profit is being overstated. So that's why in order to solve all these problems, we have this particular chapter of inventory valuation. Now, why this concept exists? Because inventory is one of the most significant assets on a company's books. Even small mistakes cascade into major financial misstatements. So, what is happening? If one small mistake will be there in my books of accounts, it will lead to what? It will lead to major financial misstatements. Now, suppose if I don't record the inventory correctly, my inventory might be overstated and understated, and the investors or maybe the decision makers might rely on those numbers and make their decisions. So in balance sheet, where it is reported as current asset. In balance sheet, it is reported as current asset. And in the income statement, how it's going to impact? Through COGS, through cost of goods sold, directly impacting the profit. So even small mistakes, they can overstate the profits and mislead the investors, which can cause incorrect tax reporting. Why? Because if my cost of goods sold is understated, I mean it should be 800, but I am showing it as only 600. What is happening? My profit is going up. If my profit is going up, I am paying more taxes, so the tax reporting is also not correct, and this triggers audit findings and restatements. That means what will happen when the auditors will come and they will cross verify our books, they will find it like incorrect, and they will ask us what? To correct the books of accounts and to restate that. To restate means what? To correct it and then publish it again. So why we are starting this topic? Because it ensures inventory reflects physical reality. What is there on the books is actually there on my warehouse. Errors are identified and corrected properly. When I have identified the errors, I should go and correct it properly. And inventory is reported at a conservative and realistic value. That means what is the actual value of the inventory, and we should be conservative, because we know as an accountant we have to be conservative because it is one of the principles. So that's how inventory accounting should also be done. Now, coming to the physical inventory count. So at the year-end, companies physically verify inventory quantities to ensure records match reality. This is a mandatory process under GAAP for annual reporting. So first of all, how do they match the inventory? They apply the cost method. That is, they will assign the cost to the inventory using the FIFO, LIFO or the average method. Then they will calculate the final monetary value. They will determine the monetary value of the inventory. Then if there is any changes in what is there on the books and what is there in the warehouse, they will record the adjustments. They will post the discrepancies and update the accounting records. If there is any error is there, it has to be corrected, and accordingly we should pass the journal entries in order to correct it. And lastly, we have to count the inventory again to verify that what is there on the hand should be there on my balance sheet as well. Both should match. So this structured process ensures that what is recorded on the books accurately reflects what physically exists in the warehouse or on the floor. So physical inventory count is required annually under US GAAP. Matlab, what does it means? That every year we should do this, the physical inventory count. It should not be done like it's not required for the interim reporting purposes. Now, coming to the adjustment journal entries. What should be the journal entries when we are adjusting our records? So if my physical count, like suppose what is happening in my books of accounts, I am showing that my physical count is 100 and the recorded one is 120. My recorded one is 120. That means the one which is actually there in the warehouse is lower than what is recorded on my balance sheet, or maybe on my balance sheet. Inventory is overstated. So what is happening? That is, we have an inventory loss because the actual inventory is not that much. So loss should be what? Loss should always be debited. And what should be credited? Inventory should be credited. Why? Because we are reducing the asset. Which asset? Inventory. If inventory is being reduced, what we should do? We should credit it. So the journal entry will be debit the inventory loss and credit the inventory. So this reduces the inventory balances to match the physical reality. Then coming to the physical count and is greater than the recorded. Now what is happening? Now suppose my physical count is 120 and the one which I have recorded is 100. What is happening on my books? On my books it is lower as compared to what is there in my warehouse. So in that case, what we will say? We will say that the inventory is overstated, and in that case we will pass a gain entry. Now gain is credited, so we will credit the inventory gain. And what should be increased? My inventory, so debiting the inventory. So we should always reconcile the physical counts with book records before finalizing the year-end financial statements. And unrecorded discrepancies are a common audit finding. So that means if we have not recorded anything on our books of accounts, that is a very common audit finding. And before even the auditor finds that particular mistake, that particular discrepancy, we should actually go and correct it off. So yes. Here is an overview given over here to us. So errors in inventory can occur at multiple points in the accounting cycle. Understanding where errors originate in the first step is to correcting them accurately. So wherever you find that okay, there is an error, we should accurately cover them. Beginning inventory errors carried forwards from prior periods ending inventory. These directly affects the current period's COGS calculation. Like suppose if there is any error in the previous year's ending inventory, previous year's ending inventory will become current year beginning inventory, and because of that my cost of goods calculation will be incorrect and my profit will be impacted. Then there could be purchase errors. That means incorrect recording of goods purchased, either overstated or understated, distorts the total cost available for sale. Now the number of goods which we have purchased, if we are not recording the number of units correctly, it can lead to what? Overstatement or the understatement. So that also we need to ensure shouldn't happen. Then ending inventory errors, miscount or misvaluation of closing stock. So this is also what? This is the most common error, and it has a direct immediate impact for both cost of goods sold and profit. Why? Because if the ending inventory is not recorded correctly, my cost of goods sold will be impacted, and if my cost of goods sold will be impacted, my profit is going to be impacted. Now we have been talking that how the cost of goods sold and profit are being impacted, or maybe how the beginning inventory and ending inventory is impacting my COGS, my cost of goods sold, or the cost of sales. It is one and same thing. Cost of goods sold or cost of sales, it is one and the same thing. Please don't get confused, guys. So We have the formula for cost of goods sold. So, how do we calculate the cost of goods sold? Cost of goods sold is equals to beginning inventory plus purchases minus ending inventory. From the beginning inventory, in the beginning inventory, we will add the purchases we have done entirely in the year, and from that we will remove whatever is left in my warehouse. Whatever is there in the beginning of year is fine. Whatever is, suppose I'll just take this example, these few examples. Whatever is in the beginning of year, this much is fine. Then I purchased some of these. Right? So this is my total inventory that is available from sale, and I am saying I have ending inventory of this much only. So how much did I sell? I sold this much. How did I calculate? Beginning inventory plus purchases minus this. So this will be what? This will be my minus ending inventory will be my cost of goods sold. So if you just take this example, beginning inventory, this is my beginning inventory. I'll take it again. Beginning inventory, this is my purchases. This much I purchased. You just go by the this size of this particular unit. This much I purchased, and this much is my remaining. This much is my ending inventory. So from this total beginning inventory plus purchases, if I reduce this ending inventory, the remaining this much amount will be my what? Cost of goods sold. That is the goods which I have sold. This will be my sales. So that's how the cost of goods sold is calculated. And if you have to adjust this formula for ending inventory, simply what you need to do, you need to shuffle the places of the ending inventory and cost of goods sold, and that's how you will get the ending inventory and cost of goods sold. Now, what is the relationship between cost of goods sold and profit? So there is an inverse relationship. There is an opposite relationship. If cost of goods sold is increasing, my profit will reduce. Why? Because in my income statement from sales, we reduce the cost of goods sold. So from sales, we are reducing the cost of goods sold. If I am reducing higher of cost of goods sold, lesser amount of profit will be left with me or not. I'll take one example for you guys. Let's take one example. I think it's taking time to open. Why? Just let me see. Yeah, sorry guys. So I was taking example that how cost of goods sold and profit are connected. So we will have sales. From sales, we will reduce the COGS, and then we'll get the profit. Right? Now my sales value is given as 1000. I am reducing 800. So my profit is how much? 200. Now my cost of goods sold is higher. My cost of goods sold is higher, 800. Now instead of 800, what I do, my sales, let it be this much only. My cost of goods sold, let me reduce it and make it 500. So how much will be my profit? My profit will be 500. So if you see, if cost of goods sold is high, profit is lower. If cost of goods sold is lower, profit is higher, right? You can see here it's the 500 profit, here it is 200 profit. So it is just vice versa, it is just ulta. So in the examination, whenever you have any questions related to these incorrect reporting or the correct reporting, how should we go about it? So we should always prepare two columns. On one side we should write what the company reported, that is the incorrect data. Then on the right side we can write what should be the correct, and the difference reveals the impact on COGS and profits. So when we'll do the questions, this will be even more clear to you guys. But in the exam, what should be the approach? Two columns we can prepare. On the one side, what we can report, whatever the company reported incorrectly, and on the one side we can write down the actual figures. Then we can take the difference of the two, and that's how we will remember. we can calculate. So this obviously example is given over here, so that becomes easier for us. So the example demonstrates how to use the two column method to identify the impact of errors in COGS and profit. So beginning inventory purchases, ending inventory COGS, everything has been given to us. Beginning inventory, as you can see, is 1,50,000, correct is 1,80,000, then purchases is 5,25,000, incorrect is 5,25,000, correct is 5,07,000. Ending inventory is 1,00,000, which is incorrectly reported, but the correct amount is 85,000. So you can see COGS incorrect was 5,75,000, but the correct COGS should be higher. Now if the COGS is understated, like if you can see, this is the incorrect one which has been reported. So my COGS is, when I compare my COGS to the correct COGS, COGS means cost of goods sold. When I compare my incorrect COGS to my correct COGS, how much is it lower? It is lower by 27,000. So my COGS is understated by 27,000. If my COGS is understated, my profit is overstated by the same amount. So this must be corrected before finalizing the financial statements. So that's how you guys can calculate if you get questions like this in your exam. Okay guys, coming to the self-correcting errors. So what is there in the self-correcting errors? First of all, that whenever we have an inventory overstatement, so that particular error, it's gonna auto-correct itself in the subsequent years. How? Let's understand with the help of the example before I explain the theory to you. So first of all, let's assume in year 1 these data have been given over here to you, that on the left side, on the this first column we have the incorrect data, on the right column we have the correct data. Now the beginning inventory has been given, purchases is given, COGS is fine, but the ending inventory is overstated. That means there was only, the value of the inventory was only 1 lakh, but I have recorded it as 1,20,000. Now if I have recorded it as like 1,20,000, because of this my cost of goods sold is understated. My cost of goods sold is understated. This should be my actual cost of goods sold, and because of that my gross profit is overstated. My gross profit is overstated. It should be 1,50,000, but it is 1,70,000. Now ending inventory this year, will become beginning inventory next year, right? So now in the year 2 I have the beginning inventory of 1,20,000, whereas the correct should be 1 lakh. So again this is still overstated. Now we have all the figures over here. Now when I see the cost of goods sold, my actual cost of goods sold over here as per the correct figures should be 3,40,000, but my cost of goods sold is 3,60,000. It is overstated by 20,000. So what will happen? My gross profit will be understated, because 4,50,000 minus 3,60,000 is coming to 90,000. But in reality, it should be 4,50,000 minus this correct cost of goods sold is 3,40,000. It should be 1,10,000. So what I'm trying to say, that the gross profit which was overstated by 20,000 here in year 1 is now understated. The same gross profit for year 2 is understated by 20,000. So because of this overstatement of this ending error, this is a self-correcting error, because of the figures are in such a way, the formula works in such a manner, the calculation is in such a way that this error is auto-corrected. Why? Because see, the correct over here should be 1,50,000 the profit, but we reported 1,70,000. Now my ending inventory is overstated. When I did the calculation, what is happening? My 1,10,000 is my gross profit, 90,000 should be my 1,10,000 is my actual gross profit, but it is actually 90,000 what we are calculating. So this is 20,000 lower. Here it was 20,000 higher. Here it is 20,000 lower. So if I see the year 1 and year 2 combined, the net impact on the profit is 0. Why? Because in year 1, what happened? In year 1 it was overstated. In year 2 it was understated by the same amount. So when we see the final impact, the impact is 0. So I hope this is clear to you guys. So we have just used the same formula which we have seen above, that beginning inventory plus purchases minus cost of goods sold will become minus ending inventory will become your cost of goods sold. Okay. Now let us see this. So what is happening? Now suppose period 1 ending inventory is overstated, so COGS will be understated. See, Period 1 inventory is overstated, cost of goods sold is understated. Because of that, my beginning inventory is overstated for period 2 and my COGS is period 2 overstated. So this is a self-correcting error. This is a self-correcting error. With the help of this example, I hope it is clear to you guys. Still, if you are unable to understand, please reach out to us and we'll be more than happy to help you out, guys. But just silently sit quietly with yourself and see this particular example. I have already explained it to you, but still, if you're not able to understand, we'll help you out. So that is saying the same thing, that how the overstatement in years 1 gross profit is exactly offset by a 20,000 understatement in years 2 gross profit. Over the 2 periods, the cumulative effect of the error on the total gross profit is 0. Now, inventory valuation, decline in value. The decline in value of the inventory, what is happening whenever inventory does not always retain its original cost. So by various factors can cause its value to fall below what was originally paid. So how we can have a decline in the value of the inventory? 3 cases could be. It's because of the physical damage, or it could be obsolescence, that means it can become outdated. Then if there is a decline in the price of the inventory, because of these reasons, what will be happening? My inventory value will decline. Then one important rule, inventory should never be overstated on the balance sheet. When value declines, a write down is mandatory under both GAAP and IFRS. That means whatever is the true value of inventory, we should record it at that only. It should never be overstated. What is the actual price? It should not be reported more than that on my balance sheet. Whenever there is a decline in the value of inventory, what we should do? We should write down the value of the inventory immediately, and this is mandatory under both GAAP as well as under IFRS. Now we have the valuation method. So as we know that the primary valuation method for is the FIFO and LIFO and the weighted average method, or maybe the average methods. But now when we have to find the value of my inventory, like what is the actual value that I should report on my balance sheet, how do we calculate that? So there are basically 2 methods. One is LCNRV, one is LCM method. What is LCNRV? Lower of cost or net realizable value. Now LCNRV method is used when we are following FIFO, weighted average, or a specific identification cost method. So if we are following any of these methods, whether FIFO, weighted average, or specific identification cost method, which method we have to follow of inventory valuation? LCNRV, lower of cost or net realizable value. What is this LCNRV? As the name says, lower of cost or net realizable value. That means my inventory value should be either cost or either my net realizable value. Whichever is the lower of the two, that will become the value of my inventory. So first of all, what is net realizable value? NRV, net realizable value. The value, the cost of the money which you'll actually get after selling of that inventory, excluding the cost to sell also. So NRV is what? Selling price minus cost to sell. So the cost of the inventory is 50, net realizable value is 55. So this is the example actually given. The cost is given as 50 and net realizable value is 55, and we have to take lower of the two. So 50 will be my what? 50 will be my cost of the inventory, like the value of the inventory, not the cost, the value of the inventory, that will go on the balance sheet. Whereas if the cost of the inventory is 80 but the net realizable value after selling it off is 60, so which is the lower of the two? 60 is the lower of the two, so that will become the value of my inventory. One important point, guys, please pay attention. If my value of the inventory is the cost, that means my cost is lesser than NRV. In that case, no write down is required. But if my NRV is lower than my cost, then we need to write down the inventory value. What is the application levels? So first of all, we can apply it at the individual level, at the group level, or for the entire inventory. So at the individual level is the most conservative approach, where we compare each and every unit of our inventory, like using the LC and RV method, and then we value that inventory. Or if the inventories are of similar type, they are all alike, in that case what we'll do, we'll compare the groups together, and that's how we'll calculate it. Whereas if it is the case of the least conservative method, is where we compare the total inventory which is there in my warehouse, rather than the group level. We are going for the entire inventory which is present in my warehouse, and on that basis we will calculate the cost of my value of my inventory that should be present in my balance sheet. Here we have one worked example over here for us in order to understand the things better. So we have been given 4 products X, Y, Z, W. For the product X, cost is given, selling price is given, cost to sell is given. What will be my NRV? Net realizable value will be selling price minus cost to sell. So 105 is my NRV, and this 100 is my cost. Lower of the two. Lower of cost or net realizable value, which is the lower of two? This 100 is the lower of two, so my inventory will be valued at 100. Then for product Y, cost is 80, my net realizable value is 70. How did we get? Selling price minus cost to sell, so 70. So lower of the two, which is the lower of the two? 70 is the lower of the two. So over here NRV becomes my value of the inventory. Then product Z, cost is 50, then net realizable value is 55. So which is the lower of the two? The cost is the lower of the two. So this becomes my value of my inventory. Then cost is 150, net realizable value is 130, which is lower of the two? 130. So 130 will become the value of my inventory. So whichever we have to take, whichever is the lower, whether the cost or the net realizable value. How do we calculate the net realizable value? Selling price minus cost to sell. So what we have to do? Calculate the step 1, calculate the NRV per unit. Compare the cost versus NRV. If NRV is lower than the cost, a write down is required. Very, very important, guys. Like suppose in this cases, NRV is lower in which case? In this case, for this product Y, NRV is lower than cost, net realizable value is lower than the cost. So in this case, we have to write down the value of the inventory. We have to record a loss in the value of the inventory. Then in which other case? In case of product W also, if you see, the NRV is lower than the cost. So in this case also, what we need to do? We need to write down the value of the inventory. We have to reduce the value of the inventory, and we have to record that reduction as a loss on my income statement. Then sum all LC and RV values, that will be my inventory value. So over here, when I have sum total all these, this becomes my value of the inventory that has to be reported on balance sheet. Then coming to the LCM method, lower of cost or the market method. So the lower of cost or the market method is used when the company is using the LIFO method. So what is the distinction over here? That how, first of all, we need to determine the market value. Cost, anyways, we will know of the inventory. But how do we determine the market value? So market is the middle value of the 3 figures. Which 3 figures? Ceiling, that is the NRV. Then the replacement, the cost, that is the cost to replace the inventory item in the current market. Then the floor value. Floor values will be what? NRV minus normal profit margin. So whichever is the middle of these 3 values, that will become my market value of my inventory. And how we will calculate in the case of LIFO, when we are following the LIFO method of accounting, we should follow lower of cost to market. So cost we will know, it will be given in the question. In order to calculate the market value, we will take middle of these 3 numbers. Which 3 numbers? Ceiling, replacement cost, and floor. Ceiling will be my NRV, replacement cost will be the cost which I will get or which will be the cost to replace that particular inventory in the current market. Float will be what? Float will be my NRV minus normal profit margin. So why this is floor, why this is ceiling? Ceiling is means the highest value which you will get, the net realizable value. From the ceiling you will reduce the normal profit margin, that will be your floor, and in between those two will be your generally will be your replacement cost. So all these three figures we will arrange in ascending or descending order. Whichever is the middle value, that will become my market value, and we will compare the market value and the cost to determine the inventory value. How? Let's see the example. I know because of the concepts, because of just lot of theory, it becomes really confusing. Let's see the question. Let's see one example on this. Now over here we have to apply the LCM method. We have one widget X over here, one item. The cost is given in the question. The replacement cost is given. Then the ceiling is given as 110, and my NRV minus normal profit margin is given as 90. So which three we'll consider in considering the market value? In these three, whichever is the middle value, that will become my market value. So which is middle one? Obviously 90 is like no is middle, none of the values is the middle one. 90 becomes my market value. So 90 and this cost I will compare, the cost and the 90 I will compare. Which is the lower of the two? 90 is the lower of the two. So 90 is the lower of the two, so 90 becomes the value of my inventory. What did I do? We will be given the cost in the question, then we need to find out the ceiling, the floor and the replacement cost. Replacement cost will be given in the question, NRV and floor price we need to calculate. NRV will be what? We have already seen the formula above. It will be selling cost, like from the sales price we will reduce the selling cost, that will be my NRV. From the NRV, if I reduce the normal profit margin, that will become my floor price. So this will be middle of the three. Middle value of the three, 90 is the middle value of the three, because again we don't have anything as in middle, but so again we'll consider the lower one. The middle one is the 90. Then from this 190, which is the lower, from the market and from the cost, we'll compare the cost and we'll compare the market. So the 90 is the lower one, so that's how it becomes the value of my inventory. So first, what is the step number one? Calculate the floor and the ceiling. Then determine the market value, which is the middle of the three figures. Which three figures? Ceiling, floor and replacement cost. So over here, replacement cost, ceiling and this three has been given. So it is being determined as 90. Then apply the lower of cost, that is 100 versus market 90. So inventory is valued at 90 bucks. So these three are the values. So the middle cost, this one is the middle one. So that's one, which is the one I am taking it as my middle value. So what is happening? What is happening? Again, one thing, my cost is 100. My cost is 100 and my NRV is, yeah. So widget X should be valued rupees 90 on the balance sheet. Initially the cost was 100. So when the initial cost was 100, now this is valued at 90. So a 10 write down will be reflected in my income statement as a write down in the value of my inventory. Then recording inventory write downs. So when I have to record the inventory loss, what will be my journal entry? So there are basically two methods. One is the loss method, and one is the COGS method. What is the difference? In case of loss method, we'll record the loss in an inventory loss account. In case of COGS method, we'll record the loss in a COGS account. So now this loss method is preferred for material losses. Material losses means what? That means whenever there is a loss in inventory which is of a huge amount, which is gonna impact my business. Anything material in accounting means what? That is gonna impact my business. So this is what? This is a material loss. So this is what? This is going to be disclosed separately on my income statement for transparency, so that the users of financial statements, they are aware that exactly what is the loss amount. So how we will record for it? We'll debit the inventory loss and credit the allowance. Then when the inventory is sold, it is removed at the historical cost. We will close the allowance account, and no profit or loss at the point of sale we will record for the inventory loss, because loss we have already recognized. This inventory loss we have already recognized. Coming to the COGS method, cost of goods sold method we use when there is an immaterial decline in the value of the inventory. Any immaterial decline in the value of inventory means what? When there is very small amount which is not gonna impact the decision of the users of the financial statements. So the write down is absorbed into the cost of goods sold. So what we have to do in that case, we will debit the cost of goods sold because it is a expense on kind of a expense, we debit it on my income statement, and we need to reduce the inventory. So credit the inventory. One example is given us, cost is given us, and net realizable value is given us. So cost is this much, but the actually realizable value is 1,50,000. So loss is how much? Loss is 50,000. So the loss is recognized immediately in the period the decline occurs, not when the goods are eventually sold. This loss occurred in year 2, and I'm gonna sell off these assets in year 3, inventory in year 3. So when should I record the loss? I should record it immediately in year 2 and should not wait for it to being sold in the market. Then coming to the interim reporting and recovery of the losses. So when do we recognize the loss? We recognize the loss when the actual decline occurs. That means do not wait, like suppose if the decline is there in Q2, the loss must be recognized in Q2's interim financial statements, and we should not wait until the year end. Then recovery allowed within the same year. Now if the value recovers later in the same fiscal year, the previously recognized loss may be reversed, but only up to the original write down amount. Like suppose if the value was initially 100, I'll take the example. If the value was say 10, I'll just take 10, the value declined to 8 in quarter 2, I will record this 2 ka loss, I will record this 2 ka inventory loss. But later on in the year end, the value increased to 12. So will I increase this value to 12? No. I will only increase up to the value with which we have recorded initially. So this 8 can be only be made 10. It cannot be made as 12. So that is what this point is saying. Then skip loss if recovery expected. Now in the Q2 I am seeing that okay, there is a decline in the value of my inventory, but I can see from the market forces and maybe because of my experience, I always see that in Q2 the value declines of my inventory, but by year end, by quarter 4, this recovers. So in that case, what we will do, the loss we defer it and we do not recognize in the interim period. We defer it means what? We delay the recognition of loss and we do not recognize it in the interim financial statements. So the recovery of inventory loss, the write down is reversed, but the reversal is limited to the amount of the original write downs. That's what previously it was 10 say it became 8 because there was a write down, but again the value increased to 12. But how much we can write up the value? Only to the amount with which we have done the write down, that is only 2 rupees or maybe $2. One very important difference is between IFRS versus GAAP. So in case of GAAP, what is happening? In case of GAAP, what is happening? This LCNRV and LCM method both are allowed, but in IFRS only LCNRV is allowed. Why? Because in IFRS we don't follow the LIFO method of accounting, and LCM is related to the LIFO method of accounting. That's what. Then very important point, guys. Please pay attention. This point is very important for your CMA US exams POV. Reversal of write down is not allowed under US GAAP. Reversals of write down is not allowed because write downs are permanent. So in IFRS, whereas it is allowed. That means my inventory value was 10 say it reduced to 8 and then it later became 10. In US GAAP, if you have reduced it once, you cannot make it back 10. This reduction in the value of my inventory, it's gonna be permanent. But if it would have been the case of IFRS, we can increase it up to 10. We cannot go further than that. So always remember, reversal of write down is not at all allowed under the US GAAP. Very important point, guys. Please remember. Then LIFO method is allowed under US GAAP, but it is prohibited under IFRS. So that's what. So that's all about the IFRS versus GAAP key differences, and that's all with the inventory. So again, one important point highlighting same thing again and again, no reversal of write downs, and reversal of write downs are permitted in IFRS. Then LIFO is prohibited in IFRS, whereas LIFO and FIFO both are allowed in US GAAP. Okay. Now, what will be some common mistakes that students will make, and what will be the examiner twists, the points from which examiner would like to confuse us. So what is the common student mistake? That using the average instead of middle value in LCM, that is the lower of cost and cost of market value. Then ignoring the beginning inventory errors, which is gonna affect our COGS. Then sometimes students might mix LC and RV and LCM. Remember, LCM is only used for LIFO method only, whereas if we are following any other method of accounting, we should go by LC and RV. LCM only LIFO, LCM only LIFO. Remember this, guys. Then forgetting the profit impact, we should always see that COGS is going to impact my profit. So we should always try to understand how this COGS is going to be impacted with my, this COGS is going to impact my profit. Then not using the two column method, as we have seen in the examples also, that in order to understand what is the overstatement or understatement in our books of accounts, we should follow the two column approach. One column we should write the incorrect data, on the another column we can write the correct data. Then examiner twists to watch for: multiple errors combined in one question. They can combine multiple errors in one question. Then they will not explicitly say that what is overstatement or understatement. You need to calculate it yourself. Then asking for effect on income instead of COGS. They will ask what will be the effect on my net income rather than what will be the impact on my cost of goods sold. Then mixing NRV and market definition in the same question. Net realizable value is different from the market value. Please remember this, guys. Then providing irrelevant numbers to distract from the correct formula. We should always remember what is the correct formula for calculating the COGS or the ending inventory. So what is the formula for COGS? COGS is equals to beginning inventory plus purchases minus ending inventory. Please stick to that. Then the most dangerous confusion: students mix up NRV used in FIFO with market value which is used in LIFO. They are calculated differently and applied to different cost methods. That's why it has been given separately in a box, guys. Please pay attention for this. Then what are some keywords and some memory tricks which has been given to you guys? So please remember these. It's very, very important. And if you are thorough with these words, if you have understood clearly, you will be good to go with this chapter. Then how to prepare for the exam preparation summary, what type of questions to expect, application based, analysis based. So what you can do next is that you can do solve some tricky MCQs for this chapter. Then you can make a revision sheet for yourself. Okay, then what you have to quickly recall for your exam, these things you should quickly recall for your exams. So always remember, when stuck on an inventory error question, write down the COGS formula first. It unlocks everything. This is a cheat code for cracking the inventory questions in the exam. That is, write down what is the formula for COGS. COGS is equals to beginning inventory plus purchases minus ending inventory. With this, we are done with inventory chapter, guys. I hope you people have understood it really well. If you feel any questions, any doubts, any confusions, please feel free to reach out to us. We'll be happy to help you out, guys. Thank you so much.